we were laughing a little bit earlier about an article and a quite in-depth piece that you wrote about residential property prices in Australia. Gone viral on our website. I don't know if you've ever had that happen before, Phil, but well done.
Certainly not.
But in that article, you labelled the economic effect of the decline in home prices as the critical financial issue in the Australian economy right now. Why is it so critical?
Well, look, everything I say I should preface by saying that what I'm talking about are risks, because it's integral to the philosophy of a value investor that you don't know what's going to happen. In fact, that's one of the most important parts of value investing, realizing that you don't know. And that the opportunities arise when people have extreme views where they think that they do.
Yeah.
And the same applies here to economics. You can't forecast recessions.
Yeah.
It's all highly non-linear, and path dependent and all these things. So we don't know. What we can say though is that we do know a couple of things that we're pretty sure about. First one is that in this boom in Australia, the price to income of homes in Australia has risen to a level that was much higher than it was in the UK or Ireland or the US pre-GFC. Mm-hmm. The debt levels have risen to a level that were much higher than in those countries as well. And we clearly know that there was considerable evidence of speculation. Again, if you compare prevalence of interest only and investor lending in Australia, reached quite extraordinarily high levels. Yeah. And we do know ever since the Royal Commissioner sort of released their data file in last May, I think, that there were some issues with the underwriting processes as well. So we have all those things that we know. And lastly, and sort of fourthly, we know that in the Northern Hemisphere, these sort of starting conditions have led into some countries to these balance sheet recessions. Mm-hmm. Where and the mechanics of these is that households see falling house prices, they worry about their balance sheet, they worry about their retirement plans, and they change their behaviour. They go from gearing up to wanting to de-gear. They want to sell assets, they want to save more and repay, and that becomes an enormous drag on the economy. And in some of the Northern Hemisphere cases, that's resulted in really sharp recessions. But for instance, in Japan, it was just a long, drawn-out grind down as people went from gearing up and perhaps spending a little bit out of the asset price gains to doing the reverse, wanting to repay. So that's clearly where the risk lies, and that's the risk that the RBA references when they talk about the risks arising from high household debt.
Mm. You've done some analysis across a number of different property decline, periods of decline that result in recession, and some of the things that you noted is that the term or the period that it takes the declines to reach top to bottom can be up to 6 years. Mm-hmm. You also called out that there's a number of retrospective-looking data points. Employment is one of them that you don't think are a great indicator or signal for people to get a sense of where we are in the cycle if there's a decline in place. So I'd like to get your view on where you feel like we might be in that cycle and what sort of forward-looking data points would you be looking at?
Yeah, look, I mean, first to sort of a slightly...
And you can caveat that with it's hard to predict the future.
It is, and what I was going to say is sort of a general point to start that one off was to say that, knowing that you can't forecast that sort of system, the best thing you can do is to look at other places where it has happened. Mm. Because, when you have a very complex dynamical system like that, forecasting it, I think, is a pretty hopeless task. But you can sort of take what's known as the outside view, what Daniel Kahneman calls the category view, and say, well, I can't do precise forecasting because it's far too complex for me to understand. But I can see what has happened in other places that gives me a guide. And that's what we did there. So we looked at those three Anglo economies I mentioned, as well as Spain and Japan. Mm-hmm. We've been through this process. And you're absolutely right in saying that typically these things take a long time. Again, just referencing the US, because that's the one that people know most about. Property prices peaked in 2006 and bottomed in late 2011, I think. Mm-hmm. They fell for about 5.7 years. And the average rate of decline was about 5.5% per annum, which doesn't sound like such a bad number. No. The damage comes from people changing their behavior. There are some people who some of the bears who sort of sometimes seem to imply that as soon as property prices fall, people can't pay their mortgage. And I think they get that a little bit from the US, where they had those ninja loans, no income, no jobs, no assets.
Yep.
We don't have those. The economic problem is not that people stop paying their mortgage at that point. The problem is that they actually do. In fact, they start paying more. Money that doesn't go into spending anymore, it goes into saving, it gets squirreled away and for debt repayment. And then you get that impact on employment. And if you look at where we are, with the typical timing of when the cuts come in, when the recession comes in and so forth, we've done those numbers. So far it's been almost textbook style. Right? In New South Wales, we peaked sort of late, middle of 17, and almost on cue by late 18, when you'd expect to start seeing results. Retail sales were down across New South Wales in the fourth quarter, and you looked at consumer confidence and business confidence and job ads and all these things, and in most cases New South Wales was worst. Property prices there start falling earlier. It's got the biggest price and debt issues, and it's fallen furthest. The really important question now, James, is it enough to lead to secondary flows into employment? Because the first stage is, as I say, that people become prudent. They want to save more again, because the saving rate, once more, household saving rate, fell to a very low level while these property prices were going up. I mean, in Sydney, there were 3 years there where the average household made more money on their property than they did through their wage. It has an effect on people's spending. They feel richer. Yeah. Now, as they start feeling poorer on the other side, and they cut back their spending, is it enough to go into the labour market? And if it does, then you get that feedback system that can cause a real downturn, because you get high unemployment, people start worrying not just about their house price, but their job, so they cut back more, and that whole thing can develop in the way it developed in the Northern Hemisphere. So far, I think, while you quite rightly say that employment is a lagging indicator, the job ads are down, but even there's some mixed signals. So at the moment, it's not clear whether that second stage is sort of happening. But really, in my thinking, comes down a lot to the psychology of the market. And I think this is where the sort of traditional economist who sees the economy in terms of levers and rates and fiscal and all these sort of things as a mechanical system can get it slightly wrong. And you recall that was the big criticism of the economics profession after the GFC. It
was all theoretical.
It was theoretical, but it was all concerned with GDP. It never looked at the balance sheet. And that was the big thing that people missed. And the economists were rightly criticised for saying, you have a model, it doesn't involve the balance sheet at all. It's that balance sheet that drives the adjustment there. And one element of that is that we're dealing with a market. Now, you and I know that markets are not just based on discount rates and the simple sort of mechanics. There's something called sentiment. And clearly, over the last couple of years of the boom, certainly in Sydney and Melbourne, there was momentum. There was a market that went up because people thought it was going up. It's the old sort of a sort of self-fulfilling prophecy. People buy it because it's going up, and it's going up because people are buying it. Yeah. And the question becomes, do we get in New South Wales, particularly in Sydney, of course, and in Melbourne, to the point where people's faith in the property market is shattered? If it is, then you have a big problem on your hand, because the momentum reverses and turns negative. And then eventually people just want to sell. Yeah. And they don't care about interest rates anymore. They don't care about any of these things. They just want to sell. And then you have a problem that is very hard to deal with. I mean, in the Northern Hemisphere, in those 5 countries I mentioned, on average rates were cut from above 5 to below 1. Did it prevent anything from happening? The answer is no. Eventually the cost of money is irrelevant, because who wants to borrow to buy a falling asset? No one wants to gear into a falling asset. So monetary policy becomes pretty much ineffective. Fiscal policy still works. So that's something we've learned from the GFC, and the events there. But it's very hard to stop a market once people's faith in it has been broken. And even, you remember a couple of years ago when the Chinese government tried to stop their market from falling. Yeah. Well, even in China, with a lot of policy tools available, you just can't do it. Right? The market will do what it wants to do.
It has to go through that point of capitulation.
Correct. The euphoria is eventually followed by concern and then capitulation, and it just falls. And I've got a lovely little story there, that you might appreciate. Our former CEO in Sydney, Rob Pruge, and I don't know whether you know him, but he was also CEO for Asia. He spent a couple of years in Japan. And you may or may not remember in the late 80s how everybody just followed the news in Japan and this enormous asset bubble.
A little early. I was interested in Steve Waugh in the late 80s. I wasn't following what was going on in Japan.
But extraordinary property price and commercial real estate bubble. And a whole generation of Japanese households borrowed far too much money to buy property in the perfect faith that Japanese property only ever went up. And I remember Rob Pruge returning to Australia, I think it was 2006-07, and talking to him, and he happened to mention that you could buy apartments in Tokyo on an 8 or 9% yield. I said, that's extraordinary. What's the mortgage rate? And he said, about 1%. I said, that's phenomenal.
Money for jam.
It's an enormous carry. Why aren't people doing this? And he said, oh, it's simple. Every Japanese knows that property always falls because they had watched 15 years of falling property prices. So you get this complete swing from a complete faith in the market to eventually a complete loss of faith in the market. If you get to that stage, and as I say, it's not something you can just fix with rates or things like that, then you have a problem that is very hard to combat because people do want to de-gear. And in all those countries that I spoke about, you can see, when you look at their credit ratio, how the private economy started to de-gear, and it's painful. Right? It's either, as I say, a nasty, sharp recession, or it's a long, drawn-out grind. But it's very hard to avoid the consequences of the prior boom.
Well, we've been talking about some of the views at a broader level, I guess, and this will be our final question on property because there's some other things to get into. But I guess where the rubber hits the road is, are your views or how are your views on the flow and effects of property reflected in the way that you're investing in your portfolio?
Look, that's another level of difficulty up on top of the uncertainty because, as I said at the start, it's really important to realise that you don't know, right? I think it was John Kenneth Galbraith who said there are two types of forecasters, those who don't know and those who don't know they don't know. Yeah. So you've got to be very careful there. So the way we like to think about it, it's a risk. And a year ago we described it as a tail risk. Today we say it's probably more than a tail risk, it's a real live risk. You only have to look at the bond yield to tell you that there are other markets who are focusing on this and saying, yep, there are some problems out there. Yeah. But we see it as a risk. So it informs our view, for example, in terms of how much we want to be in banks, because they're clearly enormously exposed to that sort of thing. And what you normally look for in investing, because there's always uncertainty, is a position of asymmetric payoffs. So for a value investor, it's buying something that is so cheap and that has such bad expectations and such bad news priced into the stock that you can buy it and you have a beautifully asymmetric payoff. If things really are that bad, it's okay, it's about fair value. But if it isn't, if it's slightly less bad, you can make money. And in some ways, in the case of the banks, I view them as being the other way around. If things are good and we just grind through it and so forth, then you still have all the other issues that banks have, in terms of credit growth. It's not going to be what it used to be, and therefore the operational leverage and all those things. Regulation is still going to be greater. Capital requirements are going to be greater. The returns are going to be less, and all of those issues are still going to be there. If, however, we do have a downturn mediated through one of these balance sheet recessions, then you have a loss, or you have the risk of a loss of permanent. Of permanent capital. So in that sense, from a portfolio perspective, we know we can't forecast this, and our central case is that there's not going to be a disaster, because how could we forecast that? But we're wary from a portfolio management side in saying we want to avoid certain risks. And what we have done in various occasions last year or so is, when we've had a choice between a cyclical stock that looks interesting and a defensive stock that looks interesting, well, let's buy the defensive because there are some possible headwinds out there. And we're quite aware of the fact that when you avoid a risk like that, you don't always get paid for it, right? You don't always get paid for it. In late 15,
you just don't lose as much. Is that right?
No, I think it's more a case of in late 15, early 16, for example, we bought heavily into the mining sector after not liking them for so many years before that during the boom. But we said, look, let's be very cautious. There could be a big downturn, so let's put that in. And we bought the safer, lower cost sort of miners on the assumption that we need a margin of safety because we don't know. And it was to protect our investors from the possibility that if you bought the higher cost, more leveraged miners, and it does turn out to be really bad, you've got some serious problems on your hands, right?
Yeah.
So in that sense, we left something on the table because we had a fantastic 16 due to buying into the mining sector, but we could have made more. So it's a risk we avoided for the clients that in the end didn't pay off because it never eventuated. And in some ways, this may be the same. Perhaps the worst doesn't happen. Everything is more or less okay. But I think you have to do that as an investor because you don't know in advance which ones will pay off and which ones not. But if you do it all the time, in the long run, you'll have a lower risk portfolio. And value portfolios tend to be low beta, partly for that reason. And sooner or later, they do happen. And then you've done a great job in terms of returns as well.
Yeah.